Hey guys, it's Crossroads here. Today I wanted to talk to you about what bulls are getting wrong with the ticker symbol open door. Now, I'm not hating on open door at all. I'm not invested in it. I'm sitting that one on the sidelines. I've made a video on it in the past. It's a sheer momentum play, maybe a meme stock play at this point. If you make money in it, congratulations. But it's important to go into any trade like this with both eyes open. And I'm seeing a big part of the thesis for a lot of people being rate cuts as a great thing for the business of Open Door. Now, it's actually not. Rate cuts are fantastic for a number of companies, including SoFi, but not so much for anything to deal with the mortgage market, including Open Door. And I do think that, though, when rate cuts hit, then that's probably going to be good for the stock market. And stocks like Open Door will probably perform pretty well. So, real quick, let's take a look at the price action here of Open Door. It is up actually massively from when Eric Jackson began to make this call, somewhere around here. And of course, it's trading at $4.04. I think he famously, or maybe infamously, depending on your perspective, said 83 bucks. I mean, maybe, but probably not. But congratulations if it goes up that high. Now, the issue with this is, yes, rate cuts are happening. We can see here that the probabilities for rate cuts have gone up tremendously, more so just because they haven't happened at all this year. And so currently it's a 1% chance that's being factored in of no rate cuts at all, 13% chance of just one, and a 47% chance of two. And there's even a good number of people that are saying possibly even three. We see that there's 3 regular Fed meetings or opportunities to actually cut between now and the end of the year. And so September, of course, the 17th is coming up fairly soon. That's the most likely for that first initial rate cut. If we don't see it, we'll probably see the rate cut probabilities go down quite a bit. Now, they don't need to just cut 25 basis points. They might do 50 as well, but probably they'll be a little bit more conservative here. So why is this not a great thing for Open Door? Why is it such a good thing for banks? Well, we need to understand basically how the mortgage rate is inferred. So this is a great breakdown on Fannie Mae. I've also got the Fed or Fred rather pulled up, but this chart right here basically says it all, that what the mortgage rate actually is. It's not some mystical number that's out there, but instead you have the 10-year treasury yield, that's in blue. You have what's called a primary secondary spread in orange. And you also have in this teal or light blue a secondary spread. Now, what are each of these? First, the 10-year treasury yield, of course, is just a 10-year bond. So if you're looking at the bond market, if you're looking at the 10-year yield, that's an important monitor to keep in mind, especially if you trade equities. But it's really important for the mortgage rates. And so the higher this rate is, the more it goes up. That's why rates were so low back here, simply because this 10-year treasury rate was minuscule compared to what it is right now. So the other 2 rates, you can see that the orange is not as variable, but there is some variety there. And then the teal, that's changed quite a bit. What are these? And so here's another way to look at this. Mortgage rate, this is going back in 2024. It doesn't really matter, though, of 6.81%. Most of it is tied to the 10-year treasury note, which is not controlled by the United States government. Instead, it's a supply-demand sort of thing. We'll look at that chart in just a moment. The primary secondary spread and the secondary spread as well. So primary secondary mortgage spread, you can see over time this has gone up. What this is the cost for borrowers. It was much lower prior to the great financial crisis because of some regulatory changes. They ended up, that rate actually basically doubled in price as a result of what happened here. And so we're sitting at around 1% that's tacked on top of the treasury note. Now, right now, as far as the primary secondary, it's maybe slightly above this. This can vary a little bit, but the secondary spread is really what it varies the most. And the secondary spread right here, basically it prices in risk and volatility. And so, some of those risks, it talks about prepayment risk, credit risk. If there's a lot of concerns with the consumer and the consumer health, yes, it's a mortgage-backed security. So if somebody ends up not making payments on the house, they're foreclosed on, and the bank does have the house as an asset, but you still lose a lot of money in that scenario. And so this is pricing in that risk and that volatility. It went way down here right after 2021, just because consumer health was really, really good. Defaults were really low. It looked like everybody's making a ton of money despite COVID. And of course, there's been a lot of pain in this secondary spread. And so as a result, that's where we're at right now. Now, going to the Fred's website, you can actually pull up these numbers yourself. This is a great resource if you're looking at any sort of rates or loans as well. And we can see I've laid out these three numbers going back to 2016. You can go back further as well. But I basically just want you guys to see this yourself. So we have up here in this darker blue at the top, that is the 30-year fixed rate mortgage average in the United States. Now, what are the other two? Well, the teal, the light blue, that's a little bit choppier and more volatile, that's the market yield on the 10-year treasury. And so you can see just with your own eyes, you don't even need to do the math, that this line is very highly correlated with that top line as well, and less so with this red line. So what is this red line? That is the Fed fund rate. In essence, this is the overnight rate of what banks are charged to be able to borrow. So this is fixed at the federal level. This, when rate cuts hit, this is a rate that's actually impacted. And so this is, if as cuts happen, this is a bad thing for companies that are trying to collect a lot of money, a yield on cash. So the Fed fund rate itself, if that's cut, that's really good for other types of lending that's actually inferred by the Fed's fund rate. What is that namely? Well, credit cards probably, but also personal loans as well. The net interest margin actually increases immensely for banks just because they can loan at a much lower rate as well. So it's a great thing for them, but not so much on the mortgage side, even for SoFi or for Rocket Mortgages or for Open Door, simply because, again, you can see with your own eyeballs, the red line there, it doesn't really have a strong correlation. Now, there is a slight correlation. I'm not saying it makes no impact at all. But again, the largest correlation there is that 10-year rate. Let's take a look at that right quick, too, because I want you to see that there's some volatility there. And we'll talk about what perhaps is driving this, too. So this is on Market Watch. Market Watch right now has the rates pegged to 4.233. This can shift a lot when they do bond auctions, which is quite regularly as well. Also, with any sort of risk or economic news, when those come out, oftentimes you'll see some big moves and changes, or also policy at the federal level. So, but the biggest impact on the 10-year is the supply aspect and also demand. And so you can think of it this way, that if the United States needs to sell a lot of 10-year bonds because of their debt and their deficit, there's a lot of supply and demand may not be as high. And as a result, they have to give higher and higher yields to be able to capture that. And so that's really the biggest issue, is the debt that the United States has. As that continues to be up, I'm not sure that we'll see this really meaningfully be impacted, other than maybe short-term blips right here, like we saw during the tariff time. Now, if we zoom a little bit further out, right around election time, there was another drawdown that hit shortly before the election. We were actually at 3.5% as well. So certainly government policy, speculation, demand, macro, all has an impact here. But again, going back, it doesn't really you can see here, it's been pretty steady for a while, since 2023. It'll be a while, I think, before we see this meaningfully impact. Now, if Doge has actually worked and made huge cuts in the United States government, that could have meant many other things as well, but that would have been really good for mortgage rates. So all this in a nutshell, I'm just trying to say this is, yes, you can probably make money trading Open Door. I'm never against a trade. If you're making money on it, great. But I keep seeing people pound the table and say, hey, rate cuts are amazingly bullish for the company. No, it's probably bullish for the stock, just because the stock market does not always move in a logical sense. And there's many people that are in that play, and even in government and certain levels of government, including Pulte, that seem to think that Fed fund rate actually infers the mortgage rate. They're just incorrect. The data is there. It's very clear. This is a well-known thing in that space and industry. So if your thesis in Open Door is all about rate cuts, I'm just saying be a little bit careful, because that's a flawed thesis. Or for any other mortgage type of company as well, Fed fund cuts will not make a meaningful difference there. Instead, you want to look at the 10-year yield. And of course, what's driving that primary, secondary mortgage rate, and also secondary mortgage rate too. Anyway, let me know what you think in the comments. If you're holding Open Door, I'd love to know, is this a trade for you? Is it a long-term thesis? And I'm curious what is constructing that thesis. What beyond rate cuts, possibly as well. Anyway, thank you for watching, commenting, and subscribing. Until next time, happy investing.